What's up, everybody? Steve here. Home affordability is at the worst levels that it has ever been before, and it sucks. There's a lot of people that are being squeezed out here. I'm going to talk about this article on CNBC, but let's talk about it for a second. Our government, the United States government, as well as the Fed, pretty much put us into this situation. Now, I think that things will change. Right now, besides inflation, our economy is contracting. It just came out, obviously, first quarter GDP is down 1.4%. If next quarter is another down negative GDP, then we're officially going to be in a recession. Our economy is contracting, so eventually I think things will level out and things will get more affordable, especially for the housing sector. But as it stands right now, with interest rates hovering around 5.55%, and the Fed expected to increase rates, the Fed rate by 50 basis points, it's just going to make things more unaffordable. However, when mortgage rates go up and real estate is less affordable, that means prices will eventually come down. We're starting to see it in our market here in Southwest Florida as well, where we're seeing more properties come to market. We're seeing more price reductions. We're seeing properties come back to market. So things are starting to happen. But what you guys want to do right now, before I get into this article, is you guys want to make sure that you're getting as lean as possible. Get out of personal debt. Get out of consumer debt. With the Fed increasing rates, that's going to have an effect on credit card debt. If you guys are in credit card debt, those rates are going to increase on you as well. So excuse me, right now is the prime time to get out of as much consumer debt as possible and start stacking money away, because there are going to be deals that come to market, whether it's in real estate or stocks. There's going to be more deals on the horizon, but everybody just needs to be patient right now. And if you guys are in a situation where you're looking at renting or buying a home and it's just extremely unaffordable, I would suggest don't take that leap of faith. Figure out a different way to put a roof over you and your family's head. Can you guys rent out a room in a house? Can you guys, if you guys are looking at a single family home for rent, is there an additional room that you can rent out to a family member? Or do you have another family member that maybe has a basement that is built out and you guys can live in and live cheap for at least a year? Because I think there's going to be a lot of changes over the next 12, 18, 24 months for the better. But the people that have money in their pocket ready to go are going to be able to jump on some of these distressed assets when it happens. This article, CNBC, home affordability is nearly the worst on record as mortgage rates spike. The average rate on a popular 30-year fix started this year at 3.29% and hit 5.55% on Monday. That's literally what? 4 months? It jumped up significantly. And, on a mortgage, that could be, depending on the price of the property, and the amount of debt taken, that could be a $300, $400, $500 per month just in the interest spread alone. The vast majority, 95% of the 100 largest U.S. housing markets are now less affordable than their long-term levels, up just 6% at the start of COVID pandemic, according to Black Knight data. If rates were to rise 50 basis points more or home prices were to increase just 5% more, home affordability would be the worst on record. Mortgage rates just hit their highest level since 2009, and home prices are continuing to experience double-digit gains. Now, nearly all of the major housing markets in the United States are less affordable than they have been historically, and affordability is near its worst point on record. Home buying affordability has not been this bad since July 2006, when rates were around 6.75%. By the way, I think, especially if they do 50 basis points on Wednesday, I think we're going to be in the 6s, 7s, maybe even 8s. Then it took about 34% of the median income to cover the monthly mortgage payment, including principal and interest, for a home purchase with a 20% down payment. As of April 21st, the payment to income ratio had reached 32.5%. Now, real quick on that, the total debt that you have, this is going to include your mortgage, this is going to include your car, this is going to include credit card debt, any other consumer debt should not exceed 36%. Me personally, I think it shouldn't even be that high because you're just not utilizing money for investments. You're putting it all toward your cost of overhead, but it should not exceed 36%. I'm not a financial advisor. Don't take this as financial advice, but I just use some common sense. The less consumer debt that you have, the less that you spend on your personal living allows more money left over at the end of the day that you can invest. The pandemic has created an anomaly in the housing market because demand is so high and supply is so low. Let me read that real quick again. The pandemic has created an anomaly in the housing market because demand is so high and supply is so low. So the pandemic, this flu that we had, created an anomaly. I mean, CNBC, you got to do a better job at actually reporting on this or use some different language because that's just freaking ridiculous. The pandemic didn't cause that. The federal government, the Fed, they all contributed to where we're at today. If they didn't do the stimulus, the money printing, the artificially low mortgage interest rates, the Fed rate being at 0%, mortgage moratorium or mortgage forbearance, eviction moratorium, foreclosure moratorium. If they didn't do all those things, we wouldn't be in a situation that we're at right now where it basically forced demand because everybody wanted to get into housing. We would have had still a flat real estate market, but they were the cause, not the pandemic. So let's keep it straight. It is often said in the housing market that consumers don't buy the home price, they buy the monthly payment. The payment is at a new high, up $552, an increase of 38% year to date to $1,809, and up $790 or 72% since the onset of the pandemic. Now, they are correct there. It says people don't buy the price of the home, they buy the payment. Now, here's where I have a problem with this, and here's where I have a problem with it with buying a car or buying anything else. I mean, you can go into any store and, you can buy a TV for $10 a month. I mean, it's ridiculous. So how I look at things, and it changed my mindset, basically in the last real estate recession, was it's not about the payment and can I afford it. It's about how can I eliminate all of my consumer debt, including my home mortgage. And once I did that, my life completely changed. And I just encourage you guys, don't rely on can you afford this mentality, can I afford that monthly payment, because that will put you in a bad position, especially if you run into a job loss or something happens in your family or there's some emergency that happens and you guys can't come up with the funds for that monthly payment. Then you're really stuck because then creditors come after you, or if you stop paying on your mortgage, then you can potentially be in a short sale or foreclosure position. So look at anything that you take debt on of how can I pay cash for it or how can I pay it off quickly. And I am such a big believer of not taking on debt for any kind of liabilities. A home mortgage is debatable. I'm definitely okay taking a home mortgage because people can create wealth through there, but not if you're paying crazy prices either, or crazy higher interest on high prices. So be very careful there. In reaction to weaker affordability, consumers are slowly turning to adjustable rate mortgages, which offer a lower interest rate. The ARM share of rate locks from potential home buyers jumped from 2.5% in December to nearly 8% in March, according to Black Knight. As of last week, the share was more than 9%, according to Mortgage Bankers Association. Look, guys, if you're considering an adjustable rate mortgage right now, that means you probably cannot afford a traditional 15-year fully amortized or 30-year fully amortized loan. So if you're looking at adjustable rate mortgage, I highly consider or recommend that you guys don't do it. Again, it's not financial advice, but basically adjustable rate mortgages are bad news. They're going to adjust after a certain duration of time. A lot of lenders out there are going to tell you, hey, just refinance in 5 years when it adjusts. But the problem is you don't know what the hell the real estate market's going to look like in 5 years. So 5 years down the road, the real estate market might be below where you guys paid for that property. Could very well happen. Long-term real estate will continue to go up, but short-term, 5 years, 10 years, 2 years, it might go down. And if you're upside down on that mortgage, you're going to have to refinance, but you probably have to come to the table with a check to refinance, or you're going to be forced to sell. But if you're upside down your mortgage, including closing costs in the back end, then you're in a bad position where you got to come to the table with a check to actually sell your house. It's a shitty position to be in. Or if you don't have the money or funds to do that, then you're going to foreclose, do a deed in lieu of foreclosure, or maybe a short sale. So be very careful with adjustable rate mortgages. And if you guys hear of any talk of 40-year mortgages, you're going to be enslaved to the freaking bank for half your life. Don't do it. And also, if you hear any talk of negative amortization loans, don't run away from them. Basically, that's like a credit card paying your minimum payment per month. It is such a bad loan. That's where a lot of people got into trouble. The last real estate recession, the Dodd-Frank Act, I think, was supposed to protect people against it. But if we see the real estate market really slow down or stop or go down, which I anticipate happening, I think those loans are going to come back to market. I was not expecting to see adjustable rate mortgages come back so hard and actually see so many people actually going for them right now. I'm astonished. And if you know somebody that's actually contemplating doing that kind of loan, send this video to them, because it's important to get the word out. And I want to help as many people as possible. So you guys are, the backbone of this channel. Without you guys, this channel wouldn't even exist. So the more people that watch these videos and get a different perspective on things, the better off people are going to be. And I'm telling you, if you're in a position where you cannot afford high rents or a mortgage, there's other ways to go about living cheaper and hunkering down and saving money and getting out of personal debt and stacking money away for when things do turn and you guys have that cash in hand to go ahead and buy distressed assets. Because guys, they are coming. It's a matter of time. We've been in this super bubble for way too long. It's reflective in the stock market as well. We're in shaky ground. We're probably coming into a recession, maybe even second quarter this year. Possibly are in a recession right now. First quarter, negative GDP. I'm nervous for a lot of people. So anyway, guys, I appreciate you guys being here. If you're not a subscriber, consider it if you want real estate news. And I will see you guys on the next video. If you are a subscriber, thanks again for being here. See you.